is out of what Jimmy was talking about. Jimmy was talking about some of the basic financial metrics that we use to analyze a company. And it could be a yogurt store, it could be Taiwan Semiconductor, it could be Intel, it could be Tesla. But if a company does become successful, if it's getting traction, to use a trendy business term, and revenues are going up, profits are going up, people have faith in the management, and you've seen investors, professional investors, give money to the company for it to grow. At some point, you're probably going to see an IPO. So what's an IPO? It's a common term, but just let's make sure we define it. IPOs are initial public offerings. And Jimmy touched on this, but I just want to expand in his segment earlier. But I want to expand on it. It was a good segue into the capital markets thing, but let's expand on it a little bit more. Corporations, and let me just go forward a little bit because I think it's kind of important. Corporations, companies, are business organizations. So you want to sell yogurt, you want to sell semiconductors, you want to sell electric cars, whatever it is that you wish to do, go do whatever you want, whatever you're good at, but you need a legal structure. And almost every country in the world has some sort of series of laws, body of laws that govern the creation of corporations and companies. I think the first company was the British East India Company, I think back in like 1750. And of course, the law has evolved since then. But companies have a few things in common wherever they may be around the world. So they're legal organizations. They're started by some individual, a man or a woman who has some idea as to what they want to do, a business idea, a business venture that they wish to pursue. They set up a company, and one key thing, and Jimmy touched on this, they protect their own liability, their personal liability for something that might happen at the company. They don't do this to evade accountability, but they do this to make sure that if there is something that goes on in the company, they themselves are not at personal risk. And this allows them to take some sort of entrepreneurial risk. So companies are organized in this way. They need funding. We talked about the capital markets in the earlier segment. They can borrow from, when they get big enough, they can borrow in the bond market and the equity market. But when they're private, they need initial boost of capital. And where does that typically come from? Now, the very initial boost of capital, when the company is in the proverbial garage, like Google started in the garage, Apple started in the garage, when you're in the garage phase and you've got an idea for a search engine or a personal computer, typically that money comes from what we call angel investors. If you take Jeff Bezos, who started Amazon, where did his initial money come from? His brother Mark, his parents, other friends and family. But when a company gets to a certain point where there's real traction, there's revenue is growing, profitability is growing, there's demand for goods or services, venture capital firms come in, VC firms, and you've probably heard a lot about them. These are firms that are taking tremendous risks by investing in new businesses. Most people don't invest in new businesses. They're risky, they could fail, anything could happen, right? But VCs take significant risk. They do a lot of homework analyzing a company, and they say to themselves, look, this is a good business, this is a good management team, whatever the case might be. So they inject money into the company. And in exchange for that, this is sort of like a private version of the capital market that we talked about earlier. The capital markets are big and public. They involve thousands, if not millions, of individual players. In the private markets, in the VC markets, we have 1, 2, 3 people who found a company, 1, 2, 3, 4 people who are VCs. They get together and they say, listen, I'll give you $10 million for 10% of your company, or whatever the case might be. So when companies start their businesses, they're privately held. They're owned by the founders and the venture capitalists. They are not traded on an exchange like the New York Stock Exchange, the Tokyo Stock Exchange, or the London Stock Exchange. That's a big thing. They're privately held. Only a few people have all the stock of the company. There's still stock, just like there is when we talk about IBM or Toyota or British Petroleum. Sure, there's stock, but it's not traded. It's held amongst a small group of people. So at some point, the company grows, and the company grows to the point where they need more capital. They also grow to the point where the venture capital people need to sell their stock because they want to take profits and then move on to invest in other companies, which is a very key thing that they do and a very, very, very important supporter of the economy. And we'll get into that in a few minutes. But instead of me talking, why don't we talk about an IPO for a company that has garnered a great deal of attention over the last 5 to 10 years, and that's Uber. Uber tends to operates in every part of the world. So let's look at a little bit at the history of Uber, and it'll give us some insight into how IPOs work. And as we said earlier, this is kind of just a snapshot of what the overall IPO module of this course will look like. We're trying to give people a flavor for it. We'll get more into this. But Uber, I think, is a fascinating case study as to how IPOs work, especially because it's high profile. It was an innovative new business. So let's just talk about it and look at the timeline. So 2009, not that long ago, Travis Kalanick and Garrett Camp, the two founders of Uber, were in a cab. We're in a cab in Paris, and it had taken them a long time to find that cab. And if I recall correctly, it was New Year's Eve 2009, and the amount of cabs in Paris is limited by government regulation. It's hard to find a cab, especially New Year's Eve. If you're a New Yorker, you know that used to be the case as well pre-Uber. So I don't know if it's Travis to Garrett or Garrett to Travis, but they say, hey, listen, wouldn't it be cool if we had an iPhone or an Android phone and we just press a button and a cab showed up? Well, they go back to San Francisco, and instead of sitting on their couch and watching TV, they actually start to implement this business. And in 2010, they launched Uber Cab. In 2011, Uber got its first venture capital professional investment, $11 million from Benchmark Capital, one of the great VC firms in the United States. And in exchange for that, they got a percentage of stock in the company. I don't know what the exact percentage was, but call it 5%, 10%, whatever it might have been. So you had an ownership group now that was Travis, Garrett, whatever friends and family initially funded them, and then Benchmark. Later in 2011, Uber gets more money in exchange for stock. So they sell some more stock in exchange for cash to grow the business. This time it's Jeff Bezos, who also started with venture capital, and the great investment bank Goldman Sachs on behalf of its clients. In 2012, Uber launches in the UK. In the United States, a competitor called Lyft, which doesn't operate in the rest of the world. So for those of you outside of the US, you may not know about Lyft, but it's a local competitor Uber here in the United States, started in 2012. Another significant event, Uber launches its UberX service, which is the online or the cab sharing, car sharing service that made them famous around the world. So that's a big year, 2012. In 2014, BlackRock, one of the largest, actually the largest asset management firm in the world, came in with some capital. 2016, Saudi Arabia invested $3.5 billion into the company, and because that was a significant sum of money, Saudi Arabia negotiated that the person who runs the Saudi government's what we call a sovereign wealth fund. This is a government organization that runs Saudi Arabia's wealth that it generates from selling oil to the rest of the world. That entity is called the Public Investment Fund. The head of that sat on the board because with $3.5 billion invested in the company, obviously Saudi Arabia wanted somebody to observe the day-to-day operations of the business. 2017, Travis resigned as CEO of the company. A huge amount of capital, $8.7 billion, came into the company from SoftBank, Tencent, TPG, and others. It valued the company at about $54 billion. This is privately held still. Then in 2009, we have this significant event that we've been leading up to. Uber goes public in an IPO managed by Goldman Sachs and Morgan Stanley. Travis Kalanick sells his stock to the public. Benchmark sells its stock to the public. Other investors sell their stock to the public. Billions of dollars comes into the company, allowing them to grow and expand further. And it also allowed private individuals, pension funds, the other types of people we talked about in the capital market section to participate in what hopefully will be a prosperous future for Uber over the course of time. So this was a significant development. So what happened when Uber went public? As we said, the company was no longer owned just by its founders and some of its investors like BlackRock and Goldman. It's owned now by thousands of individuals, multiple institutions around the world. As we mentioned, Benchmark sold out and got its capital back. It then, and this is a really important thing, so I just want to emphasize it one more time, a venture capital firm will sell its stock. In this case, Benchmark made a significant amount of money. It returns some of that money to its investors in forms of profits. And then it takes some of that capital and reinvests in other startup companies. So the cycle continues. And if everything goes well, we have new companies creating new jobs, new services, new opportunities for people, which is the whole point of the exercise, quite candidly. Another significant thing before we wrap up this section is that once a company is public, the Securities and Exchange Commission here in the United States and other regulatory authorities around the world regulate the company. And they're not telling Uber what to do and how to price its services. What they are saying, though, is you are a public company. You have, as we've mentioned, thousands of investors and institutional clients or investors around the world. You need to provide them with some level of information. The same stuff that Jimmy was talking about in his previous segment. What are your revenues? What are your profits? What are your expenses? What is your view on the business going forward? Typically, every quarter when this is released, the senior management team of a public company, Uber, whoever, will get on a earnings call and talk to investors. Mostly Wall Street firms are asking the questions, but by extension, they're talking to all their investors around the world as to how they're doing. So this is a very, very important thing, because remember, as we were saying earlier, when Saudi Arabia invested its $3.5 billion into the company, it had a senior Saudi Arabian official sit on the company's board because they wanted to know what was going with the company's revenues and profitability and all that. That was when it was private. He had to be in the loop, as we say. But now that the company is public, everybody needs to be in the loop. So that's an important aspect of going public. And we've touched on this, IPOs in the economy. Ideally, you want new businesses, new jobs, new ways of doing things. Innovation drives the economy. IPOs drive innovation. I think that's a fairly a good way to look at these things. So that's good from the corporate sector. From the investor sector, remember, IPOs are part of the capital markets. Capital markets put together people who need to invest with people who need the investment capital. If you do well and you're fortunate, and you've done your homework properly and the management does its homework properly, maybe you can be like an Apple shareholder who in 1980, if you bought at the IPO, day of the IPO, and you held it to today, you've made 76,000% with dividends, reinvestments, et cetera, on the stock. And if you look at the market cap, and I probably couldn't make the 1980 Apple logo as small as it should have been, but the market cap, the value of Apple on its IPO date in 1980 is 1.8 billion. Apple is now worth 1.3 trillion dollars. So a lot of iPhones, a lot of Macs, a lot of iPads have led to the company being one of the most successful ventures in the history of capitalism. So if everything goes right, that's what happens. But at the very least, we're hoping we're creating jobs, opportunities, new services, and new products for people around the world. So with that,
the final topic I'll talk about, just to see if you can relate to it, is the topic of diversification. Right? Diversification is really just a fancy term for spreading of risk, to spread something out, so that a phrase might be, you don't want to put all your eggs in one basket. Right? So that might be a phrase you might have come across before. Don't put all your eggs in one basket. That means you want to spread things out so you have a greater return and also spreading out your risk. One of the examples I like to use is there's a card game I used to mentor at a charity, and one of the kids used to play this company called Yu-Gi-Oh! And I picked up all these cards, and I was thinking, wow, this is very interesting. They all have different power and different abilities, and you can summon different monsters. But the idea is you don't want all the same card, because it's the same thing. It's no different than the other. But if you have a different set of cards and different abilities, that seems to be much more valuable than one card that's the same in your whole deck. And that's essentially what's called diversification, sort of spreading out your risk. And that's how I relate it to a concept that Chris talked about, which is the stock market. A market where all companies are trading, and you can have an Apple, a Nike, a Nintendo, right? If they're all good companies, you can help spread your risk rather than just betting on one thing, right? So that's how we put it very simply. And some of the questions you might ask yourself is, right, how many cards do you actually want? Which powers are best? And the answer is you probably don't want to bet, right, just on one card. We're going to have breakout activities. Again, just an example with regard to Yu-Gi-Oh! And then, maybe even baseball cards if you relate to that in terms of sports. But certainly something that's near and dear to my heart, because I grew up on comic books and I used to read a lot of comic books. As some of you may know, Marvel Entertainment, right, was owned by Disney now, and many of you might have seen the Avengers movies. And right, so this is really interesting where I can think about and relate these financial concepts of diversification. There's other concepts called correlation, which we won't go into detail here, but in the modules we talk about. Diversification with regard to the Avengers. How do I relate this financial concept to superheroes? How do they go together? Well, do I want, two Iron Men, or, somebody with the same ability of running fast, or do I want this, right? Which is more powerful, having this team who can do the same, or having this team that can complement each other? Okay, so that's just a simple way of thinking about a concept in finance called diversification. With regard to this type of program, I certainly sort of wish I had this type of program when I was going to, as I mentioned, Bronx Science. There are also other parts of this program after you study sort of all these modules. There are electives where you can choose to go deeper into some of the things you're even more interested in, which I'm sure Ashley will talk about. There are research projects within the modules, which help make all of this, all of these concepts even more real and very practical. And then finally, I believe after this whole program, you may actually you would be eligible for an internship. And for me, I've always believed deeply in practical experience, and I was fortunate enough to have an internship when I was, or research an internship when I was younger as well. It wasn't, that's not necessarily within finance, but this one would be sort of a specialization in finance. And the younger you start, the greater an advantage you'll have, and hopefully more opportunities will open up for you. Okay, so let me turn